Hey guys, it's Upstate Michael Batnick. I'm upstate today, which is why we didn't record it yesterday on Tuesday like we normally do. There was an ice storm here, so I lost power. Anyway, downtown Josh Brown is down south this week, so we have a new guest today to play this game with me. His name is Nick Maggiulli. He's the data scientist at Ritholtz Wealth Management. He's got a kick-ass blog of dollars and data. If you don't follow Nick, check it out. All right, Duncan, hit the music. All right, Nick, let's get started. You ready? By the way,
Yep.
Wave hi to the people. Say hello.
Hello, everyone. YouTube.
All right, let's start out talking about financial freedom. There was an article on CNBC. I don't remember what the exact headline was, but the gist of it was this. A FIRE person, which stands for Financially Independent, Retire Early, he paid off his mortgage early, and he regrets it. And I think the thing that triggered a lot of the internet was that he somehow lost his motivation, that the debt was like a cloud hanging over him, and that kept him motivated. But once he paid that off, he basically couldn't get out of bed in the morning. Couldn't find a reason to live.
Yeah.
What was your take, Nick?
So I understand that logic that he's using there, because if you actually look at especially extremely poor people, they actually use debt as a savings device, so that it is like a motivating factor. But I also understand why it triggered so many people, because it just sounds so tone deaf. Like, this is a guy who's like, oh, I had $150,000 a year in passive income. Our net worth was like a couple $1 million at that point. He's like probably in his early 30s. And it's like, why does it doesn't matter. You've already kind of won the game as it is. So, for those that don't know Sam, he was like an investment banker, worked really hard, made a lot of money early on. But he writes this stuff, and I don't think he realizes, because of how much wealth he has, it comes across sounding so tone deaf, right? And that's what I think is the big issue.
Who does he? I mean, he's writing for an audience of what, like 74 people?
No, his audience is huge, but I think his main point, which is don't take things easy because then you'll get lazy later in life. That's a good point. There's nothing wrong with that point. It's just when he throws the numbers in there, it's like it seems so you can't relate to it. I think his advice is good if you just ignore his current situation. As I said, I think he's already won. He doesn't realize how much he has, and that's the issue.
My point. No. I know he's got a gigantic audience. My point was, how many people are reading that are in the position to pay off their mortgage in their early 30s. That's what I'm saying. That's
73. You're right, about maybe 74,
exactly.
73 people.
So I think the internet read that piece collectively and was like, you got to be kidding me.
Exactly. No, I completely understand. It's wild. Okay, my first question for you. So you're going to hate this one. I'm just going to preface this. So in 2020, value had its worst year in recent history. The second worst year.
I'm not Gene Fama.
No. No one likes the value talk. The second worst year in history was in recent history was 1999, and as you know, right after 99, value had a big comeback. So the question is, will history repeat itself in some way? What do you think? Yeah. Value for 2021? What's your take?
So I guess to go back, why did value do so poorly in 2020? Was it a combination of ultra low interest rates, meaning that people favored growth? Because if money doesn't have any value, then what's the difference if you're going to be profitable today versus uber profitable 10 years from now? So people bid up growth stocks, just similarly, I guess, to like they did in 1999. All right, where will we go from here? Well, it's early. It's super early. But if you look at our friends at Alpha Architect, they have an ETF, QVAL, quantitative value. If you look at that as a proxy for value stocks, that thing has done horribly. Not just in 2020, right? It's not like that was just a pandemic story. Value has done terribly all the last decade. I think if you look at 3 years worth of returns, the S&P is up 50% and QVAL is up, I don't know, not very much, a single digit. So the spread has been wide and widening for years now. And it's early. It's February 16th or 17th. Mm-hmm. And QVAL is up quite a bit compared to the S&P. I think it's 10 versus 4. So anyhow, is this the year that value makes a comeback? I think everything is in place. You saw retail sales numbers this morning blew it up. Department stores up 23% month over month. So Nordstrom, Macy's, those would certainly be value stocks at this point in time. I think the table is set between the reopening, frankly, that's what it is. Casinos, airlines, everything is in place for value to have a monster year. So if it doesn't, and not because of the 1999 parallels, but just on its own volition, if value doesn't work this year, again, given the environment, given how cheap all of the value factors got, whatever metric you're looking at, they got super, super, super cheap last year. So if it doesn't snap back this year, throw it out the window. If it doesn't work this year, I don't know when it ever will.
I agree. I think reopening is going to be huge. I think that's going to be a big thing to see play out, and I think there's going to be a big backlash away from a lot of the stuff like Clubhouse and all these social apps are taking off right now. I don't think we're going to be sitting around talking on phones all day in the future, but I could be wrong.
I was talking about this with Ben yesterday. Clubhouse. I mean, once we go back to living our lives, does anybody want? I mean, I know this thing is like scalding hot right now, and people are saying this is the future. Does anybody want to sit around and listen to people chat once we go back to our lives?
Yeah,
I think people are just lonely right now.
Yeah, I agree. I think people are going to want to go out and do things in real life, and vaccine. That's it. We're waiting on vaccines. That's basically the game right now.
All right, I want to talk about global inflows into equities. So Bank of America Merrill Lynch had this chart, and using a dollar amount is sort of misleading, right? Because the market is so much bigger now than it was that, of course, we're going to have, so it really should be on a percentage of something. I don't know what that something is, but it should be on a percentage basis. My question to you is, where is this money coming from? These are not stimmy checks, right? These are not like $1,200 deposits that are hitting equities. Where is all of this money coming from? So 2020, I guess maybe I'm going to answer my question. 2020 was a record year in terms of inflows into bond funds. Is that money coming out of bonds going to stocks? Where do you think this money's coming from?
I think it's mostly coming out of money market funds. I mean, if you actually looked, I did a little research on this, and it's mostly coming out of those funds which aren't paying anything, and so obviously people are searching for some sort of yield of some sort of return, so they have to go into equities, right? And if you actually look, the AAII has an asset allocation survey they do every month, and so they'll show, okay, what percentage is like the average investor in equities. Remember, it's a survey, so it's not perfect. I know you guys don't like surveys, but so the high I remember was, I think December 2017, it was something like 71 or 72% into equities, which is stocks and stock funds. It got as low as 55% in March 2020. So when values decline, it's going to go down naturally. But now it's sitting about 67%, which is kind of where the average where it's been for the last few years. So I'm not seeing anything. I mean, of course, maybe this month will change that significantly. I don't think too much. I mean, nothing seems that crazy to me. I'm not seeing these outlier type events, right? So based on what I'm seeing right now.
You're not going to see outlier type events in AAII, but did you see like penny stock volume going crazy and option volume, obviously?
There are outlier events there, but I'm saying in just general equity allocations, I'm not seeing anything that says like, wow, this is really crazy. Like if you start getting past where we were in December 2017, then I can say, okay, maybe this is getting wild again, right? Because we're at 72, 73%, right? And once you get over 70, that's when the market starts to get generally overheated, at least according to this data. It goes back to 1989. And every time it's gone over 70, if you do a basic trend model, you sell above 70 and then buy at 50, it works, but we only have a couple data points where that happened. So
what's interesting is right now we're seeing not just U.S. stocks. The Nikkei is at a 30-year high. European stocks are breaking out. Emerging market stocks look great. So it's everything. It's not just U.S. stocks that are leading the world higher.
Yeah.
What do you got?
For my fourth question, short interest as a percentage of market cap is at the lowest since 1999. What do you think about this? I mean, it's kind of wild what's happening right now with shorting. What's your take?
So the chart is not quite as jarring if you were to like squeeze the axis a little bit. The decline looks way more drastic than it actually is. Anyway, be that as it may, what do I think of this? I think we've been in a bull market for like the better part of the last decade, so this is not surprising. Shorting stocks is incredibly difficult always. It's harder in a bull market. I don't think this is necessarily a reflection of like what happened with GameStop, because this chart was going in the right direction for the last few years anyhow.
I mean, I think that if there's echoes of 99. I know last year I wrote, oh, this is nothing like 99, but now it's seeming more and more like it because of the different things that are happening with, especially the short squeezes. That type of stuff was happening in 99. That stuff's happening now. And so it's like there's now more echoes of that. Yeah, there's more echoes of that type of stuff that's going on that wasn't happening before. And I don't think like the market overall is like that, but there are pieces of 99 that are just all over the place now. And I think we're seeing that with, for example, people paying for, non-fungible tokens, this random thing. Like people are paying for some digital object. It's like, what is happening? Like I don't understand what's going on right now in markets generally, and money just flying around for almost no reason.
It's because you're old. You don't get it. So you saw that chart floating around of a basket of the most shorted stocks. This went back, I think, 20 years. And generally, people short stocks because the businesses that they're shorting suck, right? That's why they do it. And lousy businesses have lousy stocks. So you saw this chart going down, 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 down for a few years or decades. I don't know how long it goes back. And then all of a sudden, 2020, 2021, spike. I mean, really, that chart is an outlier. Like what we just saw, that was interesting.
Yeah, and it's the Wall Street Bets people coming on in and starting this revolution that I think a lot of other hedge funds and other retail investors got in on, which is just the short squeeze, and it's the time for it.
Do you think that GameStop was their apex? Are we going to see anything like that again?
I don't want to say ever again, but anytime, no. Like right now that I can't imagine more attention going to one individual stock in the future in any short time period. So I think that was like an apex of trading. So.
All right. I want to move on and talk about, man, what a year. So Goldman Sachs just put out this chart, which shows Q4 earnings per share in the S&P 500. I'd love to see what it was in the Russell 2000. But in the S&P 500, Q4 EPS was 2% higher than it was pre-pandemic. So just looking at that metric, we have fully recovered. We have fully healed. I know real world that's not real world, but just earnings per share. I mean, I'm sure a lot of this has to do with the fact that Apple and Microsoft and Google have never done better. So I'm sure if you look under the hood, there's still a lot of carnage going on, obviously. But my question to you is this. Given that the recovery has been so quick and relatively so successful relative to other recessions, and I know this was an outlier with the pandemic. This is not a normal type of recession. Has the playbook for policy response fundamentally changed, where we saw the fiscal response, the monetary response, or was particularly the fiscal response a one-off to the fact that everybody was home? Everybody was home.
I think so. Looking at how they did things fiscally, I mean, they probably could have done more, honestly. And I think people would say that, like they could have had checks out quicker. They could have had larger size checks. That's going to be a big thing I think we're going to hear about. And that's why people are still talking about this now in the current stimulus. Now, the argument is like, oh, it worked, but maybe it only worked in the short term, and the long-term consequences of injecting all this money, and people start talking about inflation, hyperinflation, all these types of arguments, which we'll find in the Bitcoin community and other communities out there. So I'm not exactly sure how that's going to pan out. I think that's
a good point.
The trade-off, right? So it's short-term versus long-term. And so if there's no long-term effects, this is a win. This is a huge win. But I think a lot of people are going to argue that there's going to be these long-term effects that we can't even imagine right now. Now, historically, every time people have said that, they've generally been wrong, but doesn't mean they're going to be wrong this time. And so I want to kind of, have a balanced approach in how I think about this and stay open-minded. And of course, I believe that if you keep doing this, you can't just keep printing money infinitely at the same time. I do think things like hyperinflation are a little bit overblown. I don't think the data supports that. But that's kind of how I see what's happening right now. It's a short-term versus long-term trade-off, and policymakers are making those trade-offs for us. And we're just going to have to see how it plays out. And right now it looks good, but you're right. Like, who knows what's going to happen in the long run? All
right, last topic. What do you got?
So Dave Ramsey, did you see his little rant? I think it was on Fox News or something. You saw the rant?
Yeah.
Okay. So he said he wouldn't forgive student loans. And I think that's the big thing. I don't want to talk about him saying, oh, if $600 changes your life, that's this whole separate topic. Let's not get into that. But he said he wouldn't forgive student loans. What's your take on the whole student loan thing? Do you think there should be some sort of policy response, at least, or full forgiveness, or where are you on the spectrum right now?
I'm sorry. I can't gloss over the fact that he said that people that need $600 might be mentally incompetent or whatever the he said. Those are just absolutely abhorrent comments. I mean, What a jerk, right?
Yeah,
I mean,
I think it's just he lives in a different world in his head, and he has to see things his way, and I think that's the only way he can do what he does. I think I'm starting to, the more I watch these people who get very successful in these like personal financing, they have to become ideologues. I think you have to be so narrowly focused on one idea and preach that one idea so much that you cannot accept anything else, any other data that suggests otherwise. And I think that's how you have the confidence to be successful. But that's what I'm saying. Like, Dave Ramsey is loved by a lot of people, but he says a lot of really just insensitive stuff like that. Like, that's obviously, it's really bad to say. Like, mental, like, you didn't even need to say any of that. You could have made a decent argument without saying all of that. But it's like, he is in this, like, if you can't get your life together, it's all your fault, that type of stuff. And that's
is a shame,
though. Yeah.
Which is a shame, because he does have some good advice. And I thought that what he was saying, like, was not too far out there until he made those comments.
Yeah, of course. I agree.
I think that, I forget what the numbers are, but people that have $10,000 of debt are often more burdened by it than people with $50,000, because the people that have more debt, I'm generalizing, have higher paying jobs. So do I think that if we're going to do some debt forgiveness, that we should target areas where people will need it more? I honestly don't know that we have the capability to do that. So if we're going to make the decision to help people out, I think giving money to people that don't need it, like overspending, sort of like what we did with the PPP stuff, is probably you're probably better off doing it that way. I have mixed thoughts. On the one hand, I love helping people out, people that are burdened by this broken system. On the other hand, I hear the argument from people that said, well, wait a minute, I just paid off my student loans, or this is creating a moral hazard. Like, I get that. So I don't want to like be so wishy-washy, but on this one, it's complicated. This is not a black and white issue, I don't think.
Yeah, I think the first thing I should do is just drop the interest rates. I mean, okay, if just drop interest to zero, like, get rid of all the interest. Like, okay, that's the littlest, that's the minimum. Like, everyone just get rid of the interest. Okay, you want to help people out? Yes, that's costing money, but like, people shouldn't have to be paying more and more money. I think that's kind of crazy, especially with how rates are basically at zero now. Why don't the borrowers get those rates, like, at least for this, in this instant, So that's the first thing I would do. I'm not opposed to.
What about pausing payments until somebody's income goes above a certain threshold?
I mean, you could do that. It can be tough to, like, then there's gonna be donut hole effects of like, oh, I should work less. I don't know how much big of an effect that's gonna be. It's all really comes down to the details in that instance.
Well, that's what I'm saying. We don't have the capabilities or the infrastructure to be making these sort of decisions on the margin. I think we need to either do big swaths or do nothing. Whatever we do, there's going to be people that are pissed off. We said we didn't do enough, or we did too much. So
yeah, and there's the people that saved up all this money and paid off their loans right away, and then and they're the ones who are like, well, I paid off my loan. Why don't I get like a $10,000 grant or something? So how do you like make it fair for everyone? And that's a good question. I don't know how to do that. And that's why I don't think like full forgiveness across the board for everyone's going to make sense, because some people took out 100 grand in loans. Some people took out 10 grand in loans. And it's just like, that's not going to make sense. I think getting rid of the interest, even though that's still not technically fair, I think that's more fair, and that's going to be more helpful for more people, just to start, and then maybe a smaller forgiveness that's equal across the board. Like, everyone gets 5 grand, 10 grand, whatever. That could at least be a start,
A lot of this is political theater, and we need to the system needs to change, because what happens right now, it's broken. It doesn't work for anybody, I don't think.
I agree.
All right, Duncan, let's move on to some listener questions.
Hey, Nick and Michael. So first up for you, Michael, Rondal writes, hey guys, love the show. I'm a novice trader learning and getting better thanks to you guys and others. I'm beginning to look at dividends for longs to hold more than 10 years. What should I be looking for aside from a shiny high dividend?
Yeah, I would say that's what you shouldn't be looking for, is a shiny high dividend, because you don't want to buy what's called an accidental high yielder. A stock that used to have a dividend of 3%, and then the price gets cut in half, and now you're at 6% or more. So you have to ask yourself, with interest rates where they are, with the 10-year at 1%, and the dividend yield on the S&P 500 is roughly 2% or so, why would a company be offering its shareholders 8%? They wouldn't. So if you're seeing dividend yields in the double digits, be very careful. That is like a bright red light And if you see anything above, I don't know, call it 5%, I certainly would do some digging. Look at their dividend payout ratio, look how much debt they have, look at their cash flow, and look at their dividend history. Make sure that they've been paying a dividend for the last, 10 years or so. So those are all good places to start, but I would not look at a dividend yield alone as an indication of whether or not something is a good investment.
Okay, and so then for you, Nick, Nathan from Canada writes, with the recent surge of Wall Street bet stocks, I have clients legitimately disappointed in their 30% rate of return in 2020. I was tech leaning and had some cash available in mid-March. Is it time to fire these clients? If they aren't happy with 30% during a pandemic, should this be a warning sign? This makes me very bearish, but what are your thoughts?
Yeah, so 30% when the S&P returns 16%, they should be thanking you. They should be sending you letters. They should be, buying you nice bottles of wine, whatever. I mean, this for my clients, I would fire them. I mean, they would probably never become my clients in the first place. You gotta like find that type of behavior early and just get rid of it. That to me, that seems kind of crazy. Like if you got a 30% year when everyone else is getting 16, 17%, whatever, plus or minus a couple percent, depending on the index. I think those clients are just going to, because I'm telling you, as soon as you underperform even slightly, they're going to hate you and they're going to leave anyways. So do you want to do it now when it's easier, or do you want to wait and, and deal with it when it's much harder? So that's kind of the trade-off you're dealing with when dealing with clients that are very, very performance focused, especially when you're doing well, like you're actually doing well. You would think like, yeah, I can understand when this performance focus comes up when you're not doing well, but you are doing well and they're still upset. It's crazy talk, in my opinion.
All right, Nick Maggiulli, thank you for joining. Excellent substitute. Excellent.
Thank you. Thanks, Michael. Thanks, everyone.
All right, thanks for watching, guys. Josh will be back next week, and we'll see you on Tuesday. Have a nice weekend.